What is an IPO? IPO stands for Initial Public Offering. It's when a private company sells shares to the public for the first time. Basically, it goes public. From that moment on, its shares are traded on a stock exchange like the New York Stock Exchange or Nasdaq, and anyone can buy a piece of the company. Before the IPO, the business is usually owned by a small group of founders, employees, and private investors. After the IPO, everyday people, like you or me, can invest too. Why does it matter? For the company, an IPO is a major milestone. It's a way to raise large amounts of money, which can be used to grow the business. Things like expanding into new markets, launching products, hiring staff, or paying off debts. It's also a way for early investors and employees to cash in on their work. Shares they have held privately can now be sold to the public, often for a significant profit. For investors, IPOs can feel exciting, like getting in on the ground floor of a potentially big company. When well-known names like Airbnb or Facebook go public, it often makes headlines. Here's a simple example. Let's say there's a successful food delivery startup called Speed Eats. It's grown quickly and now wants to expand across Europe. To do that, it needs extra cash. So Speed Eats decides to go public, it files paperwork with regulators, hires banks to help, and lists its shares on the London Stock Exchange. It offers 10 million shares at £10 each. That's £100 million raised. From that day on, anyone can buy Speed Eats shares using an investing app or platform. If the business does well, those shares may rise in value over time. How do shares get listed? To list shares, a company must meet the rules of the stock exchange it chooses. This includes financial checks, reporting standards, and making regular updates to the public. The company also works with banks and advisors, called underwriters, to decide how many shares to offer and at what price. Once everything is approved, the shares are officially listed, and the company becomes a public company. What else should you know? An IPO doesn't always mean instant success. Some shares rise quickly on day one, while others drop. For example, Airbnb's IPO priced shares at $68, but they opened at $146 due to high demand. That shows how IPOs can attract hype and volatility. It's also worth noting that not everyone gets early access. Most IPO shares are first sold to large institutions like banks or pension funds. Regular investors usually get access when the shares start trading on the open market, often at a higher price. There's also a lock-up period, usually 3 to 6 months, where insiders like founders and early employees can't sell their shares. Once that period ends, some may cash out, which can affect the share price. Lastly, not every company wants to go public. Some prefer to stay private, especially if they don't need funding or want to keep control without public scrutiny. To sum it all up, an IPO is when a private company lists its shares on a stock exchange for the first time. It's a way to raise money, grow the business, and allow public investment. While IPOs can be exciting, they also come with significant risk and volatility, so it's important to stay informed, not just follow the hype. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.